Equity markets are active in August. From mid-July through the first few days of August, a period of about 3 weeks, global equity markets have declined sharply, and many U.S. equity indices, including the large company S&P 500, are well below recent all-time highs. In the first few days of August through August 5th, the market drop accelerated, and the S&P 500 erased 3 months of gains, trading back to early May levels. The decline since July 17th, which was an all-time high for the index, reached about 8.5%, and it's the largest S&P 500 pullback since a 10.2% drop in 2023. The 2023 correction played out over 2.5 months, from August to mid-October, while this 2024 decline, which perhaps remains underway, has developed more rapidly. When a market decline approaches 10% or more, investor anxiety surges to uncomfortable levels. Just 2 weeks ago, reported U.S. economic growth, gross domestic product, or GDP, for the second quarter was 2.8%, which was better than expected and better than the first quarter. That, along with inflation data that resumed moving lower in the second quarter and lower interest rates, appeared to support a sector rotation in U.S. equities that saw some profit-taking in many of the high-growth technology stocks that led market gains in the first half and led to gains in the other sectors that had lagged the broader market and could benefit from continued sustained economic growth. Much more recently, however, some economic data has been weaker than expected, especially the labor market, as July jobs growth missed estimates, the unemployment rate ticked higher, and weekly jobless claims set a multi-month high. Manufacturing and housing have also been weak. This has rekindled recession fears and drove more broad-based selling that included technology and growth, but then also included other economically sensitive sectors. For now, we believe the rotation, though, remains in place. We're cautious on overall gains for the S&P 500, though, which means investors should scale back return expectations, but we see the recent weakness as a relatively normal correction. The average calendar year peak-to-trough decline for the S&P 500 since 1980 was about 14%, so this current decline for now is below that. Long-term investors should stay the course and follow their investment plans. Continue to look for opportunities to rebalance positions, especially if we see pockets of strength. Trim the overweight holdings and add to the underweight positions. We would not be surprised to see additional market weakness, but we want exposure to high-quality companies that are market leaders, are generating positive cash flow, and have solid balance sheets. We could also see investor buying support on further weakness, as second quarter corporate earnings reports for the S&P 500 have trended above estimates, and 2024 economic growth, while slowing, is expected to remain positive. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.